Interest on loan taken. Generally, loan appears on the credit side of trial balance. It means the loan has been taken from outsiders. It is a liability. The interest on loan taken is an expense. Treatment in final accounts. Interest on loan taken appears on the debit side of trial balance. Being expense, it is debited to profit and loss account. If interest is outstanding, such outstanding amount should be added to interest paid, given in trial balance. The outstanding interest is also added to loan on the liability side. Interest on loan given. If the loan appears on the debit side of the trial balance, it means that the loan is given to outsider. Thus it is an asset. Then interest on such loan will be an income. Treatment in final account. Interest on loan given appears on the credit side of trial balance. Being income, it is credited to profit and loss account. If there is accrued interest, the amount accrued is added to interest on the credit of profit and loss account. It is also added to loan on the asset side of the balance sheet. Interest on capital. Sometimes interest is allowed or charged on capital. Interest on capital is an expense for the business, but it is an income to the proprietor. The entries are: 1. Interest on capital account debit. 2. Capital account. 2. Profit and loss account debit. 2. Interest on capital account. Treatment in final accounts. Interest on capital is debited to profit and loss account. At the same, it is added to capital account on the liability side of the balance sheet. Interest on drawings. Sometimes interest is charged on drawings. It is an income to the business. The adjusting entry is drawings account debit. 2. Interest on drawings account. Treatment in final accounts. It is shown on the credit side of profit and loss account. At the same time, it is deducted from capital in the balance sheet. Manager's commission. Commission is shown on the debit side of P&L account. It should also be shown on the liability side of the balance sheet if it is given in the adjustment. It is calculated as follows. A. Fixed percentage of net profit before charging such commission. In this case, commission is calculated as follows. Product of net profit and rate of commission divided by 100. B. Fixed percentage of net profit after charging such commission. In this case, commission is calculated as follows. Product of net profit and rate of commission divided by 100 plus rate of commission. Deferred revenue expenditure. Deferred revenue expenditure is written off over a number of years. Heavy advertisement is an example. The entry to write off advertisement is profit and loss account debit to advertisement account. Treatment in final accounts. The amount to be written off is debited to profit and loss account. The balance is shown on the asset side of the balance sheet. For example, a firm spends Rs.500,000 on advertisement and it is expected that the benefit would last for 5 years. In the first year, Rs.1 lakh is debited to profit and loss account. The balance Rs.400,000 is shown on the asset side of the balance sheet. In the next year again, Rs.1 lakh will be debited to profit and loss and balance Rs.3 lakhs will be shown on the assets side of the balance sheet. Thus the deferred revenue expenditure is proportionately charged to profit and loss account and the amount remaining to be written off is shown on the asset side of the balance sheet. Goods sent on approval basis. Sometimes goods are sent to customers on sale or return basis. If goods are approved by customers, it is treated as sold. If not, these are returned to the firm. However, when goods are sent on approval basis, it is credited to sales account and debited to debtors account. If on the date of closing of books of account, such goods are still lying with the customer awaiting their approval, these should be treated as part of closing stock. The following adjustment entries are needed. A. To cancel the credit sales recorded at the time goods were sent on approval basis. Sales account debit with sale price to debtors account. B. To include the stock lying with customers into closing stock. Closing stock account debit at cost price to trading account. Treatment in final accounts. The goods which is sent to customers on sale or return basis lying in stock should be shown On the credit side of the trading account by way of deduction from the sales at sales price and added to the closing stock at cost price. In the balance sheet assets side, it will be deducted from debtors at sale price and added to closing stock at cost price. Final account adjustments are necessary to ensure that the financial statements show a true and fair view of the business. They help in recording incomes and expenses in the correct accounting period and in presenting assets and liabilities at their proper values. By making these adjustments, the correct profit or loss for the year is ascertained and the trading account, profit and loss account, and balance sheet are prepared accurately. A sound understanding of these adjustments is therefore essential for correct accounting and examination success. If you found this video helpful, please like the video, share it with your friends and classmates, and subscribe to the channel for more such easy and detailed accounting lessons. Don't forget to turn on the notification bell so you never miss an update. Thank you for watching.
Thank you.